This is a presentation on Mr. DIY, where I'm going to talk about the company as a whole and also the valuation analysis to see whether the stock price is overvalued or undervalued. These are some of the contents that I'm going to cover, and the summary here is just a detailed description of what I'm going to talk about in the following slides. So the introduction. The company here, Mr. DIY, is a home improvement and hardware retailer that sells, home improvement and hardware products across its physical stores. In 2020, in late October, it just got publicly listed in the Malaysian stock market, and the position itself the position that the company has placed itself in the stock market is that in the past 3 years, the Malaysian stock market has not seen the ringgit of funds that has been raised for the initial public offering as high as Mr. DIY in the past 3 years, and also in 2020, it is the only company that has raised a billion ringgit for its initial public offering. And in the past 3 years, from 2017 to 19, it has achieved one of the highest EBIT margin at more than 30% at that period. And also in 2020, as it stands today, it has 734 physical stores across Malaysia. And to give you some context here is that the one-stop superstore, which is the second largest player in this sector, have only 64 stores in Malaysia as compared to 734 stores from Mr. DIY. So for the company standing here, so this matrix is just to show you where the company stands in the industry. Key takeaway here is that it faces very strong competition horizontally and vertically from new entrants and existing rivalry, and also the substitution because of low barriers to entry, and also many companies have minor market share in the industry itself. But the good thing here is that it faces very weak supplier power. This is because its top supplier only accounts to 5% of its total inventories, which means that the supplier cannot put price pressure onto Mr. DIY to curb its EBIT margin. But in this industry, we know that consumer power is very high, and the company cannot deviate from this because of easy substitution from from other alternative from other stores or e-commerce site, and also the competition from new entrants, and also existing competition in the industry means that it's easy for the consumer to just find alternative. As for the SWOT analysis, the strength lies in its high EBIT margin, and also the physical store operations. The high physical store operations across Malaysia means that it will gain more and more market share over the next few years. The weaknesses here is that higher inflation in the future might put wage pressure, and also the higher expenses in the supplies. Therefore, it will increase the expenses overall for the company, and hence lower EBIT margin. The opportunity here is that the company has been investing a lot in its in expanding physical store operations across Malaysia, installing artificial intelligence into its warehouse, and also technological improvement into its e-commerce site. And when the latter two, the artificial intelligence and also the technological improvement, starts to come into fruition, we can see that the company will streamline its warehouses, which will make moving inventories to be more efficient, and also the putting more weights into the revenue gain from e-commerce site, when the technological improvement starts to come into uh, when the investments starts to um, pay off for the e-commerce side. The threats here might be, increase because uh, the majority ownership of the company is held by the founder and also its family. So what I believe is a major threats is that I worry there will be increasing family-based decision making influencing the company to deviate its main or its core operations outside of the home improvement retailing. So this is one of the threats that the company should consider. As for the company, as for the current standing and also the current trajectory of where the company is going, we can see that the Malaysian home um, improvement retail growth or in 2019 up to 2024 is expected to be 10.2% in that period. This means that um, the high growth will help um, Mr. DIY to improve its EBIT margin and also increase its revenue growth in that period also. We can see on the bottom right corner, the column there is just to show you where the EBIT margins, Mr. DIY EBIT margin stands as compared to its closest peers, ASEAN peers actually. We can see that, at 30% EBIT margin, it almost double that of, its closest peers like Ace Hardware at, 10 to 12%. This is a very significant number for the company because high EBIT margin and high profit margin means that it can help, it can generate more value to the current shareholders. And from the home improvement retail growth, Malaysian improvement retail growth, it means that the company is going to capture more and more market share as it goes from here today, from 2021, where it will capture more than 50% in the year 2016 to 2027 to 2028. Whether you believe that 55% is too high or too low, it's up for debate, but that's where the company is going to generate, uh, where the company is going forward with its expansion strategy. You might ask, why I don't take Malaysians, the domestic peers for the EBIT margin comparable. This is because that there's not enough data or there's not enough publicly listed company in Malaysia under the same sector for me to make comparables. Therefore, the easier or the most reflective of where the company is going as compared to its peers will be taking companies around ASEAN areas. This is just a visual picture of where all of the physical stores is placed across states, including Brunei. We can see that states like Selangor and also Kuala Lumpur takes up the most operations for Mr. DIY at 245. Now let's talk about the valuations. For the valuation, I've adopted four key metrics here. For the 4 weeks trading, which is from its IPO inception up to the 20th of August 2021, 8 brokers target and scale it down to the base case to the highest the most optimistic case by the brokers. The DCF valuations that I've computed and also the trading scom which is to take the ASEAN peers and take its multiple to see whether the share price is fairly valued or overvalued. We can see that based on the three key majority of the metrics here suggest that the current share price at 3 ringgit and 90 cents is peaking at its at the highest at 4 weeks trading 4 ringgit and 24 cents. So we believe that the share price is fairly valued or almost uh, uh, overvalued. But the only thing that deviates from the fairly valued assertion is that the broker's target believe that the current share price is still undervalued because its highest share price at 4 ringgit and 85 cents means that it has more tractions to gain in the next forward near term future, 1 year, half a year. Well, whether you believe that's optimistic, whether that's achievable or not, that's up for debate again. But that's what the brokers believe the company is going where the share price is going to go in the near half a year, near term future, let's just say. So for the trading multiple, no trading comp, like I've said just now, the criteria for this comparable is that they must have positive earning, that they must be placed or they must be listed in the ASEAN region, and also it must be operating under the same industry, the home improvement retail sector. Three key multiples: price to earning ratio, EBITDA multiple, EBIT multiple. All three of the multiples suggest that the stock price is overvalued. Now let's move on to my valuations or the discounted cash flow valuations here. Major assumptions: terminal growth rate reflecting the home improvement retail growth rate in 2030 in Malaysia at 4.5%. WACC calculations reflecting the country risk and also the country default risk, and also which help us to come up with the cost of capital at 6.88%. Terminal value EBIT margin at 16%, and also the terminal market share for the company at 55%. All of these computed in the discounted cash flow will give us the intrinsic value of 2 ringgit and 51 cents, which is negative 36% relative to the current share price at 3 ringgit and 90 cents. Whether I've adopted and I've computed the sensitivity analysis here, where you can see from the previous two slides that there are small margin of safety for you to gain if you invest right now at 3 ringgit and 90 cents, because the most optimistic case is that the share price can gain up to 4 ringgit and 30 cents. But that margin is not enough to cushion any volatility in the share price. So that's the conclusion for my discounted cash flow, where I believe that the current share price at 3 ringgit and 90 cents is overvalued as compared to my intrinsic value, or the other way around. The current share price is overvalued based on my intrinsic value. So what's the proposition here? What's the play here? Whether you should just go long, go short. Although I'm not proposing any option strategy here, but yeah, just to give you what plan am I going to do with the valuations. So based on this, majority of the valuation analysis suggests that the stock price is overvalued. Therefore, my strategy here is just to sell the stocks. Yes, to sell the stocks. But there are rooms for the stock price to increase because the broker's target believe that the current share price is only the beginning of where the share price is going to rise up to 4 ringgit and 85 cents. And we know that the brokers, the insiders, shareholders, retail traders, brokers have more influence than my actual than my actual execution of the investment. Therefore, it's what I worry is that people might leave out my you know my might lose out on the upside benefit if the share price tilts on the upside benefit on the share price increases in a year forward future. But if you look at the graph below, we can see that the share price has gained close to 100% since its IPO inception. But the total returns here is that it's just to show you the 44 weeks trading weeks since its inception, and we can see that the earlier 2021, we can see the share price to increase tremendously because of lower COVID cases in Malaysia, and also the easing of movement restrictions across the states, which help push up consumer consumption and also to push up the consumer sentiment and optimism throughout the whole country. But when the COVID cases starts to rise again and MCO starts to be implemented again throughout the whole states, the share price has been relatively flat from from mid-May to up to 20th of August in this year. So if you believe that the share price is going to increase, that story might depend on the optimism and also the increasing sentiment from consumers, and also restrictions starts to ease again. And that I believe that the share price will start to increase. But as it stands today, I think I will stick to my plan to sell the stocks. And if you believe that the current share price does not reflect the story or the growth story that the company can do in the future, then I believe that there are three key reasons for you to just invest into the company, to buy into the growth trajectory of the company. One of the reasons is that the first reason actually is that it has high return on equity as compared to its peers at 17.9%. Its second closest peers, Ace Hardware at 10.9%, does not come close to Mr. DIY at 17.9%. And this means that all of the reinvestment into the expansion strategy, technological improvement, artificial intelligence is paying off well to the shareholders, where the shareholders' equity has been rising year after year since its inception, or since it started its business in 2017. And the second reason is that based on the prospectus, the company has said that the average number of customers per month that they have recorded ranges from 6.8 million to 8.4 million. And the average transaction per customer is that they will spend 22 ringgit up to 25 ringgit in each physical stores. And if you compute the numbers itself, I expect that based on the case 1 and case 2, which is the most optimistic case, and the base case is that the customers or household will spend between 168 ringgit up to 132 ringgit per month in Mr. DIY store. And do you think that is achievable? And I do think that's achievable based on the case 2, where I can see myself spending 132 ringgit in the Mr. DIY store for hardware stuff, home improvement products. And that if that operating metrics were to sustain itself, or if the value of the transaction that the customers will make each month increases, it will help improve the profit margin over time into the future. And that translates into the third strength that the company that if you believe that the growth trajectory is achievable, or it's plausible for the company, is that the company um, has 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 declared a 40% dividend payout ratio, which is not, they are not obliged to pay, but it's just a guideline. And what I assume is that if they do pay out the 40% each month, each year to the shareholders, that is very attractive for shareholders, because the current condition, the current market condition here is that not a lot of company has been paying out uh, consistent dividend because of the COVID crisis and stuff. So these are the three key strengths that you should consider if you are buying into the growth trajectory of the company. And if you do consider investing into the company, you are taking yourself into, yeah, you are taking ownership of some of the firm specific risk that the company will take on, or is apparent or is inherent into the company. One of the things that what I worry the most is that in Malaysia we see a lot of you know family owned conglomerates where decision for the company are made based on the family's best interest, and not the shareholders interest as a whole. And in this case, in Mr. DIY, the founder is the majority ownership is held by the founder and also its family, and that the founder is also the um, executive vice chairman of the board. This means that what I worry the most is that into the future, once the CEO steps down in its 2-year term in 2023 and 2000, and if he does not renew his post as the chief executive officer, I worry that the founder will start imposing more family-based decision for the company, and starts to deviate itself from home improvement retail throughout the whole country, and start going into the healthcare, going into the real estate. This is very apparent in the in Malaysian corporations. Therefore, this is one of the risks that I worry the most if you start investing into the company. Though this risk is far into the future, but if you are going to hold it, like from my discounted cash flow model, assuming that you are going to hold for 10 years, I these are some of the this is one of the risks that you need to consider for you if you are one of the shareholders in the company. And the second reason for the second type of risk is financial risk from the company. Although I've said that the reinvestment into the expansion strategy is paying off well to the current shareholders, the increasing lease obligation because of the expansion strategy at 734 stores across Malaysia is that the lease obligation has almost multiplied at 4 times as compared to 2017. I do not believe that the company is in distressed condition, because its capital ratio stands at 0.2%, which is which is the average of the peers from the ASEAN region. But this is one of the risk, one of the financial pressure that you need to consider for the shareholders and also for the company itself, because if the trajectory of the expansion strategy were to continue in 2021, the company is expected to have 915 stores in Malaysia and Brunei. This means that when the 3-year, usually the contract for the lease contract is up to 3 years, If the lease contract is to expire, all of the stores expire at the same date, same time, same year, they have to renegotiate all of the leases, all of the contracts again for 915 stores. I don't know whether that's, that sounds significant or not, or whether this is a significant issues to consider. But I do believe that, it takes a lot of time to do all of the contracts and also the renegotiations, which, might might push up some inefficiencies in the management. And also the second issues with the financials here is that year over year, throughout the past 4 years, is that its inventory turnover has been decreasing. Since this means that, they are taking more time, taking more time to turn inventories into sales, which, might suggest some inefficiencies in the company. Especially for 2020, this is, because of the COVID year. We understand that, but if the 2021 year does not improve, then that might suggest some issues within, um, surplus of inventories without turning it into sales. We can see that in the inventory turnover days in 2019 was 127 days. It increases to 148 days in 2020, and this might suggest some inefficiencies also, like I've said, for the just now, for the inventory turnover ratio. So analysis shortcoming. This this pie chart here is just to show you the weights that I put in to show you some of the downfall or some of the risk that are involved in my analysis that might not truly reflect the company's standing. The first one, of course, is the market share at 55%. Do I think that's overly optimistic? I do think that, the numbers will range in between that number because of, high competition, increasing e-commerce site from other competitors, which will, eat out all of the market share for Mr. DIY. But that is the number that I'm assuming at 55%. And also for the EBIT margin, on one side I'm overestimating market share, but on the other side I'm underestimating EBIT margin. This is because, I believe that higher inflation, higher wage growth, higher wage pressure, and also supplier power starts to kick in because of, easing restrictions and also better economic growth. So higher inflation will start to push the expenses higher, therefore lower EBIT margin. And my assumptions here is that the terminal EBIT growth will be 16%, which compared to the current EBIT margin at 22%, it's a significant decrease overall for in the next 10 years. Valuation risk, it's not a lot because I don't think my cost of capital is wrong, or the growth rate is incorrect, because it's reflective. The growth rate is reflective of what the retail the home improvement retail sector is going to grow in Malaysia, and also the cost of capital is reflective of the country risk and also the risk premium associated with the company. And so I don't think that's a lot of issues with that. The only influence here is that any changes in the market share and also EBIT margin will change the valuation of my DCF. So that factor needs to be considered for the valuation risk here. And the momentum trade. Like I've said just now, that my actual execution of the stock price will not actually matter to the current share price, because we know that the key drivers for the stock price here comes from the brokers and also the retail traders, the insider shareholders. we can see from the broker's target, they believe that the current share price at 3 ringgit and 90 cents is the beginning of the growing trajectory up to 4 ringgit and 85 cents. This means that my the three key metrics will not actually comes into fruition because of the momentum behind the share price driven by retail traders and also the brokers that will push the share price higher and higher in the near term future. Therefore, there must be some deviation between the actual calculations that I've computed, my intrinsic value, and also the current share price in the future, like in half a year and a year, because of the drivers from brokers and also the retail traders. So let's talk about the conclusion here. So to sum up, we've talked about the company as a whole. We talk about its growth prospect and also the valuations here, and then the rationale on why you should buy the company, even though our intrinsic value based on three key metrics suggests that the stock price is overvalued. We've concluded that my conclusion here is that I will stand strong with my position to sell the stock because of my DCF valuation, and also majority of the metrics suggest that it's overvalued. And you might wonder when I will start going into the long position. Only when the share price fall within 2 ringgit and plus minus 5 ringgit to give me a little bit of margin to give me enough upside benefit from 2 ringgit up to my DCF valuation or the intrinsic value at 2 ringgit and 51 cents. And I don't believe that the share price will fall within 2 ringgit from now on in the near term future because of like I said, the momentum trade coming driven by the brokers and also the retail traders, which the forward guidance for the share price by the brokers all suggest that the share price has more to gain than more to lose. So the only downside, the only time that the share price will mean revert or tries to come down to average out of the upside benefit that it has gained will only happen, I believe, in 3 years time or 5 years time, when the growth prospect starts to come into fruition and the company starts to mature in the industry itself. And so that concludes my presentations. A sell position on Mr. DIY that has not a lot of conviction here, but I still believe that the stock is quite overvalued based on some of the fundamentals that we've talked about in these presentations. Thank you.